All right. Man, this lighting is not great. We're going to try something else out here. I got the ring light in front of me and everything, and it's not great. So this is my first live video, folks. Live from the front room, also known as the kids' playroom. I was thinking I was going to do kind of my regular content, record a video and make it all pretty and edit it and all that. But one of my people that I follow, Timothy Ward, shout out Timothy Ward. He does a lot of live streams, and so I thought, well, let's just hop on and let's just chat and talk about some things, talk about investing. And I've been reading a book, got it from the library, My Warren Buffett Bible. And it's just a book full of, and I take lots of notes, but it's just a book full of Warren Buffett quotes, which is kind of cool. So I thought I would, and I've written down a bunch of things about it too, as y'all can see. So I thought I would just hop on and chat about investing and tell you a little bit about how I started investing, and we'd kind of get after it. So yeah, let me read the first quote that I wrote down. Take a little drink. Excuse me. And you know what? We might wait for a few folks to hop in. I'm not sure exactly how this works. Let's see. We got. All right. Well, cool. Well, we'll get right in. So the first quote that I want to talk about, and we'll kind of make our way through a couple here tonight. But the first one is Warren Buffett says, "The risks of being out of the game are huge compared to the risks of being in it." The risks of being out of the game are huge compared to the risks of being in it. And for those of you who don't know, Warren Buffett, one of the most prolific and successful investors of our time. I think he's a pretty good person to listen to when it comes to investing and investing habits, and how to pick stocks, how to invest long term, just good principles. So again, that's why I got this book, and I thought I'd give it a read. But as you all know, the market has been kind of crazy these days, and let me just pull some things up. I'll give you some numbers. So today is April 22nd, 2022. Market had a crazy day. The market ended, the S&P 500 ended 2.77% down. And it has had a few down days previous to it. I think one of them mixed in there was a day when it was up by quite a bit. But what we've seen lately is just the market being really, really volatile, right? So I remember when I first started investing, if the market would fluctuate just little bits here and there, if it had a couple down days in a row, it wasn't too big of a deal. The swings weren't huge. If it had a couple up days in a row, the swings weren't huge, not a big deal. But now we're seeing swings of 2% in a day, 2+% in a day. And it gets kind of crazy. And, if you're anything like me, or if you follow anybody on these personal finance pages on YouTube, everybody's telling you to invest, right? But one thing that you might be kind of feeling and thinking is, I don't want to invest because I don't want to lose my money. It's risky. I don't control it. I was actually listening to a podcast or a YouTube video of Dave Ramsey today or yesterday, and the person that called in said that they had like $400,000 saved up in a savings account, but they didn't want to invest it because they didn't control it. They feel like it was out of their control. What if the market tanks? What if they lose? I think the lady actually said, like, what if I lose 50% of my money? What if I lose half of my money? That seems reckless. And I can understand that. We work hard for our cash. Having that extra margin and working to save up that money isn't easy, right? So it can be scary for sure. It can be scary for sure to put it somewhere where you think you might not have control over it. But again, the risks of being out of the game are huge compared to the risks of being in it. So let's just kind of start with thinking, why would Warren Buffett say that, right? Basically what he's insinuating is the person that doesn't invest is taking a bigger risk than the person who does. Okay, so let's look at historical data. So historically, we'll do historic returns of the S&P 500. And according to Investopedia, the S&P 500 index acts as a benchmark of the performance of the U.S. stock market overall, dating back to the 1920s, in its current form to the 1950s. The index has returned a historic annualized average return of around 10.5% since its 1957 inception through 2021. Okay, that's pretty cool, right? So if we look back to the 1920s, right? So over 100 years, the S&P 500, which is a group of the 500 largest companies in the United States, the average return has been 10%. Now, 10.5%. Now, what I want to reiterate is that this 10.5% is an average. It means that some years were 10.5, some years were a lot more than that, some years were a lot less than that. Maybe there's a couple strings in there where the stock market lost a lot, right? And so if you would have put your money in at the beginning of the year, maybe by the end of the year, you lost 15%. We've certainly seen those years. On the flip side, we've certainly seen the years where you throw some money in there and you gain 20% in the year, right? These past couple of years, if you're new to investing, kind of like I am, these past 3 years have been pretty darn good for the stock market. You kind of throw some money in there and it's just going up. We're starting to see that possibly change. We've seen over the past few months that the market's going down. However, again, if we're looking long term, if you're investing for retirement, if you're investing for a goal that's 10, 20, 30 years down the road, I think that average of 10.5% is a pretty good number to lean on. Doesn't mean that it will be exactly that in the future. We can't tell the future, but it seems like a pretty good number to lean on. I recorded a podcast, it's probably several months back now. And I don't think, according to my research, I don't think there was I want to say it was a 10-year period where the S&P 500 had a negative return if you were to keep your money in. It's never had that before over the course of 10 years. So that's pretty cool. So we know the risk of investing. We know the benefits of investing now into something like the S&P 500. And just to preface kind of when I'm talking about investing here, I'm talking about investing in kind of widely diversified index funds or ETFs that are mimicking an index like the S&P 500, that are mimicking or following a big group of companies that are well diversified. I'm not talking about individual stocks. That's a very different discussion. Lots of people have gained a lot of money. Lots of people have lost a lot of money. That's not a way I typically invest. If I do, it's with a small percentage of the amount that I'm investing. So we're not even going to talk about that. We're just going to assume you're investing into like an S&P 500 index fund or ETF. We'll talk about, kind of returns of what you see with that. So we've seen the potential, we've seen the benefit of investing, right? 10.5% average return over the past 100 years, 102 years. So when Warren Buffett talks about the risks of being out of the game are huge compared to the risks of being in it, well, what does he mean? Well, for the folks that aren't in it, right? So what are you doing with your money? Well, most people that aren't investing are saving, right? People that aren't investing are typically saving their cash in something like a savings account that you might have with your local credit union or your local community bank, or maybe one of the big national or international banks. Maybe you have your money just sitting there. Well, the risk with that, while yes, it might be federally insured up to $250,000, which is what you see when it says FDIC insured. Take it right here. So yes, while it might be federally insured and you don't necessarily have a risk of losing your money, quote unquote, you don't have a big upside of gaining much money either. So one thing I do know is that the average interest rate paid on a normal savings account with like your credit union, like I said, is 0.01%. It's nothing. It's nothing that's even going to be noticeable, even if you have several $1 million in that fund, right? So a risk of keeping your money is the lack of growth that you're going to see from having your money in an investment, in a well-diversified investment. What's the other risk? And a risk that we're really seeing now over the past, since the beginning of the year, maybe even earlier. This is a risk of inflation and what that's doing to our cash. So inflation is basically the rise of costs of goods and services. And if you've been buying or doing anything you know that goods and services are certainly going up in our country. We're looking at gas prices, groceries, vehicles, homes, even just services, building homes or servicing your house when contractors come to fix something or whatever. Most goods and services are increasing by a pretty dramatic amount. And I read something that in March the inflation rate was I believe 8.1%. It was just over 8%. So that means that not only is there a risk with the missing out of the opportunity of our money growing if we're investing our money, but we're also seeing the risk of our money becoming less powerful when it's just sitting there and not growing. Okay, now one thing I'll preface is that this 8.1% inflation rate that we saw in March is not necessarily normal. It's the highest inflation rate that we've seen since I believe the 70s. So a typical inflation rate I believe is between 2 and 3%. But when we see inflation rates 8%, well, what that makes me want to do is try to at least keep pace with inflation. I at least want my money to grow at the rate of inflation, hopefully more, right? If your money isn't growing at the rate of inflation, your money is going backwards. It's becoming less powerful. Your money's not going to go as far. So a perfect example is, somebody back in, I don't even know, just say the 1950s might be able to buy a loaf of bread for 50 cents, maybe less. I don't know, just using this as an example. But if you take that 50 cents and you just set it on your countertop, and then today went out to the grocery store and tried to buy something for 50 cents, you're not getting much at all, right? And that person probably thought they were doing a good thing by saving that 50 cents, but in fact, they were doing a terrible thing. They are devaluing their money because inflation caught up eventually, okay? The same thing will happen with your money. If you keep that money in a savings account, you wait 30 years, now you're ready to retire. Well, the average cost of a home might be $300,000 today, but in 30 years when you retire, it might be $500,000, $600,000. Okay. So just to kind of wrap up this discussion, this quote, the risks of being, again, the quote from Warren Buffett, the risks of being out of the game are huge compared to the risks of being in it. I think that's kind of what he's talking about. And, I try to apply those principles to my investing habits as well. Just to talk to y'all about how I started investing and how I overcame my fear of investing. It wasn't glamorous by any means. If you've watched any of my content, any of my videos, or particularly my podcast, it's been around a little bit longer than I have been on YouTube here. You kind of know my story. I should say, you kind of know my family story. My family, we got into a bunch of debt when we got married and started having kids. We had kids young. My wife stayed home with our firstborn and still stays home to this day. And we racked up a bunch of debt, $40,000 plus of debt, vehicles, personal loans, furniture, credit cards. I mean, we had it all. And it was very paycheck to paycheck. I kind of got sick and tired of being sick and tired, as Dave Ramsey would say. And, I hated that feeling of all the hard work, all the money that I was working hard for coming in was just going right back out to pay off all these debts. So decided that we wanted to get debt free. And so we worked really hard on doing that. We achieved that. But once you get debt free, you kind of start to ask yourself, especially even when you get close to being debt free, you start to ask yourself, well, what's next, right? What do I do with my money? I grew up in an environment where my parents didn't invest, my friends didn't invest, or at least I didn't know about it. We didn't talk about investing. So I didn't know what to do with it. So I started just educating myself by reading books, listening to podcasts, watching YouTube videos. And I learned about investing, and I opened up an Acorns app. I opened up an Acorns account, and I still use this account to this day. I'm a huge fan of Acorns. And I started investing $5 every Friday. And it was not much. It was an amount of money that I didn't even know was gone out of my bank account. But I remember it might have been a year I was doing that, and I looked in there, and there was some money in there. And I looked at it, and I realized that it had grown, which is really cool. So that kind of spurred me on to learn more about stocks and index funds and how that works. And then one time I logged into the account and I noticed that there were dividend payouts. I didn't know what the heck a dividend was. So I researched what dividends were and how they pay out and what that means and how that can benefit me. And, once you start to see progress in investing, it becomes a whole lot easier to be more aggressive with it because you see the benefit it's having on you. It becomes a lot less scary. It becomes more familiar, especially as you educate yourself through this. And that's exactly what I did. And I realized early on when you see the wealthy folks that either have, a house that you would desire to have or that have the security that you desire to have or that are debt free, which you may desire, or able to travel, which may be a desire of yours. The wealthy people, even if just retiring and being able to be self-sustaining and live a good life, right? Those folks, I believe most of them invested in one form or fashion. Investing is the way the wealthy stay wealthy. And so I wanted to apply those very same principles to myself. So I just kind of learned the importance of investing. Um, and then quick plug, I'll put this in the show notes, but or in the description. I'm so used to doing podcasts. If you are interested in using Acorns, I think it's a great platform for a few things. For the recurring investment, like I was doing every Friday, they also have a feature where you can do roundups, so you can add a debit or credit card to it, and every transaction you do, it'll round it up to the nearest dollar and throw that spare change in your investment account. It also has like Roth IRAs and kids investment accounts and what have you. I've been using it for I think 5 years plus. It's one of my main investment vehicles. But anyways, there's a referral link in the description. If you use that, open your account, you get $5 free, and I get a little kickback from that. So that'd be really cool if it's of interest to you. I'm trying to think what else. Let's kind of crack open and just read through some of these things. I was hoping to have some people in the chats doing Q&A. Again, this is my first live stream, but I don't think I have anybody in the chats yet. So if you're watching this post it being live, if you post something in the comments, I'd be happy to answer any questions you have or give you some feedback on anything. We'll just kind of pick up where I left off in the book. Most people get interested in stocks even when let's start over. I think I need to quench my thirst here. Okay. Most people get interested in stocks when everyone else is. The time to get interested is when no one else is. You can't buy what is popular and do well. This is super interesting. This is actually, there's a couple quotes in here that are along the same lines of this, and something that I was thinking about just kind of driving to and from work. It's really easy to kind of just go with a pack, right? So we think about NFTs. When NFTs get really popular, everybody wants to jump in, and a lot of the upward mobility is gone at that point. Or what the pack is doing isn't always what we should be doing. We should kind of be thinking counterintuitively, or we should be thinking, what is everybody else doing? I might need to do the opposite. And that's kind of what he's talking about here. If it's popular, let's say Bitcoin blew up. Well, who are the people who won big with Bitcoin? Yes, there are some folks, and I have Bitcoin. That have gotten good returns from it over the past 2-3 years when it's been popular. And the people that won big were the people who took a chance on it really early on when nobody was talking about it, when people said that it was stupid, that it wasn't real money. People that threw a couple $100 in then when Bitcoin was $8 per Bitcoin, most people did pretty darn well if they held their investment. That reminds me of a story. I was working at a marketing company. I was selling marketing solutions. And I remember I was on YouTube and I watched this documentary about Bitcoin. I'm like, man, what is this Bitcoin? What is blockchain? Still don't have a great concept of blockchain, how it works, but I kind of know what it is. And I came into work that day and I said, hey, have you guys ever heard of this thing called Bitcoin? And they looked at me. I'm always the idea guy, right? So I came in with this idea. They had no idea what I was talking about. I thought I was stupid. I said, I think I want to buy one. I think the Bitcoin at that point were like $240 a Bitcoin. And I was broke at that point. So I actually didn't end up pulling the trigger, but that would have been a great opportunity to do something that everybody else wasn't doing, right? I don't remember what people were investing in or what people were into at that time, but I know it sure as heck wasn't Bitcoin. I know the people who took that opportunity to invest in it did pretty well. Another thing that I was kind of thinking about along these lines is just the housing market. And I've had a big desire to buy a different house. I love real estate, kind of obsessive over it, if you ask my wife. And I would like a house that has a finished basement. I'd love to have some house on some land. And I was trying to think how this principle could fit into those desires. And I think a lot of people are buying and selling their homes, and particularly with interest rates increasing. I think the last time I looked at interest rates were at a little over 5%. But with interest rates increasing, I thought, well, maybe it's time to kind of lay that down. Like, let's zig when everybody's zagging. let's hold on to the house we have. We have it at a great interest rate, and see if we can capitalize on an opportunity when the market does cool off and maybe there's not so much demand for inventory and we can get real estate a little bit cheaper. So yeah, I thought that was kind of applicable to my life situations. All right. You don't need to be a rocket scientist. Investing is not a game where the guy with the 160 IQ beats the guy with 130 IQ. Rationality is essential. It's interesting. My investing is very straightforward, not complicated at all. I invest mostly in the ETFs and index funds. Anything I invest outside of that's like a small portion. I'm talking 1 to 5% of my investments are in like individual stocks or cryptocurrencies. I have one NFT, one NFT that I bought for $40. It's now worth $24. And if if you've been following my content, I bought this NFT. The value increased to like $80 within a couple of days. Well, it's at $24 now. Cheers to that. All right. We like stocks that generate high returns on invested capital where there is a strong likelihood that it will continue to do so. For example, the last time we bought Coca-Cola, it was selling at about 23 times earnings. Using our purchase price in today's earnings, that makes it about 5 times earnings. It's really the interaction of capital employed, the return on that capital and future capital generated versus the purchase price today. As long as we can make an annual 15% return on equity, I don't worry about one quarter's results. The propensity to gamble is always increased by a large prize versus a small entry fee, no matter how poor the true odds may be. That's why Las Vegas casinos advertise big jackpots and why state lotteries headline big prizes. Great investment opportunities come around when excellent companies are surrounded by unusual circumstances that cause the stock to be misappraised. We'll read these last 2 pages. 4 more quotes. Draw a circle around the business you understand and then eliminate those that fail to qualify on the basis of value, good management, and limited exposure to hard times. I missed the play in cellular because cellular is outside of my circle of competence. There you go. I can't be involved in 50 to 75 things. That's a Noah's Ark way of investing. You end up with a zoo that way. I like to put meaningful amounts of money in a few things. I actually really resonate with this. I like to keep my investing simple. I have literally a few index funds, ETFs I invest in, and then have some fun with cryptocurrency on the side. I also have my 401k that I invest in regularly. But if you take a look at the folks that do really well, usually larger gains are made by exactly what he's talking about. Meaningful amounts of money into a few things. And to tie in the other quotes, a few things that Warren Buffett actually understands. So if you have a firm understanding of something and you're putting meaningful amounts of money into it, hopefully, and chances are you're going to do well with it, right? That's essentially what Warren Buffett is saying. There is a thing as being over-diversified. Right. So if you're buying, $5 of every cryptocurrency, if one cryptocurrency takes off and it increases 20,000%, well, you did okay, but it's not as good as studying it, figuring out which one has the best legs, the best management. That might be even the most stable. And if you pour $1,000 into that and it increases 20,000%, you're in business. You're making some good cash. Yeah, so there definitely is a thing as being over-diversified, for sure. And then the last quote that I'll read here, I read annual reports of the company I'm looking at, and I read the annual reports of the competitors. That is the main source of material. So I hope you pick something up from this. I'm going to do this more often, do some more live videos. I'll have to get my camera set up a little better than it was, get the lighting a little better than it was today. But thanks so much for joining me. And again, I hope you got something from this. If you have any questions, if you want any feedback, post that in the comments and we'll talk very soon. See ya.